Stuart, welcome. Can you describe the investment philosophy that Ramius uses?
So Ramius focus specifically on the hedge fund area of the alternative space. From a philosophical standpoint, what's key about hedge funds is that they bring and introduce different sources of returns. At the same time, it needs to be protective, so that if traditional asset classes like equities are suffering, that ultimately this portfolio can preserve capital for clients. The return streams in the portfolio need to be return streams that ultimately the client is not being exposed to in the other parts of their asset allocation. In addition to that, from a philosophical standpoint, we're always looking for the most suitable opportunities around the world. From a country selection standpoint, asset class, investment style, unique opportunities that you won't find again in your balanced fund.
Thanks, Stuart. Can you explain the portfolio construction process?
With Advance, we're documenting and researching what the most favourable opportunity set is at a point in time. That becomes a critical input to the portfolio construction process. What we're then doing is looking for ways in which we can ultimately invest in that opportunity set. Sometimes that requires hedge fund managers. So you'll see in the allocation process an allocation to alpha. Hedge fund managers, they can invest in various markets but deliver an excess return over and above what the market return is. Identifying a handful that we feel, given the opportunity set, these are best-in-class, skilled and unconstrained managers. We also consider other ways of getting to an opportunity set. So you'll see an allocation in the portfolio called replication. Replication essentially seeks to, through a measurement process, identify what are the key factors or exposures that a group of hedge funds ultimately are taking on. So what we've done is we've created a new index or a new type of market exposure. It doesn't look like a traditional market exposure like the Australian All Share or S&P 500. This market exposure to us becomes a replicating factor that explains some of the outperformance of hedge funds. Here what we're looking to achieve is essentially the same properties, the same return profile as if you were invested in a group of hedge funds. The benefit, very fee efficient, we're not having to pay exorbitant hedge fund fees. Daily liquidity, completely transparent, so we can measure risk and we can manage risk from day to day. We're always looking for diversification. Diversification is important, both in that we're hedging market risk and at the same time that we have investment styles that are very fluid. The benefit of this is that as the market actually may deteriorate, you're actually being able to build positions that are actually short the market, that will be profiting as the market deteriorates further and further. The last part of the allocation is an allocation called alternative beta. Return streams that aren't traditional in nature. And these return streams, again, are not going to be found in your balanced fund in the normal course of business.